Welcome to the Alternative Investment Show. My name once again is Kerry Stevenson, and I'm delighted to have you here on the program. Now, listen, ladies and gentlemen, today I am really, really delighted that we have managed to get time with James Rickards. He's an American lawyer, he's a speaker, he's a gold speculator, he's a media commentator. He's also an author of a number of books, most of which I've read, not all of them, but most of them I have read. One of which I've actually got sitting right here, The New Case for Gold. We are going to be talking things gold today, ladies and gentlemen. James Rickards, welcome to the program, sir. Thank you so much. I know while the world is blowing up around us, your phone has been blowing up. You have been one busy man. So to my listeners out there, we are so lucky to have his time. So before I get right into what we're going to talk about today, I just want you to know that he wrote his first book. It was called Currency Wars back in 2011. Yeah, which is really interesting. And then he wrote The Death of Money, The Big Drop, The New Case for Gold, which I've just showed you, The Road to Ruin, and the one that I've read and reread, and I cannot find it this morning, James Rickards.
The most recent one is called Aftermath, right?
Yeah. So, James, we're living in really interesting times. Obviously, right now, the day I'm talking to you is I think it's the 9th of April, 2020. Back in January, in fact, I sold my house on the 23rd of January. At the time, my son told me that I was a crazy woman, and now he says, "Mum, you look like a genius." This is the Black Swan event that you have been talking about. No one saw it coming. James Rickards, what is going on out there?
Well, there's a lot going on, some of which people are very well aware of and have some information on. Other things I think are coming that are not as well understood. And even for the things we think we know about a lot about, we don't know as much as we wish we did. So let me just kind of unpack that a little bit. So the number one event, which we all know about, is this pandemic. I've been tracking it very closely since January. There's a very good tool for that. I think a lot of people have encountered it. The Johns Hopkins dashboard. It's the thing I like about it, it's all numbers and graphics. There's no politics, no spin, just raw data, but present it in a very user-friendly way so that you can break it down by region, by city, by country. It has curves. You can look at the slope of the curve, the steepness, the flattening, if there is any, et cetera. So that's my number one tool. But now, of course, listen to a lot of opinions, read a lot of analysis, try to just get as much information as I can. So the pandemic aspect of it is clear that the death, the fatalities tragically are very high and growing. But one thing I'm looking at is how it's spreading around the world. Now it's in 184 countries. I think there are only 190 countries in the world. So suffice to say it's everywhere, but it's not everywhere in equal measure. Of course, Wuhan in China suffered greatly, although the Chinese pretty consistently lie about the numbers. So I think it's not unreasonable to say that their actual experience could be as much as 10 times worse than the numbers they reported. But that's a debate for another day. But shut down the Chinese economy, really, which is the second largest economy in the world. Now the epicenter really globally, not just in our region, but globally, is New York City, where there are more deaths reported than in Wuhan. And quite bad in Italy, Spain, and elsewhere. So we see that. Unfortunately, it's starting to spread in Australia, Melbourne and Sydney, of course, and we're seeing it pop up in South Africa and elsewhere. Now here's my point. This virus apparently spreads far more easily than people realize at first. We don't even know all the ways it spreads. There's some obvious ones of, someone sneezing around you or something, that's bad enough, but apparently it can be airborne, it can be spread by touch, et cetera. Highly contagious, seems easier to get than people thought at first. What that means is that when you see 5,000 reported cases, it wasn't that long ago that New York City had 5,000 reported cases, and today they have 75,000 reported cases. So, and growing, exponentially. So a lot of these places where you say, well, they only have 5,000, they're okay. They're not okay. Come back a week from now, 2 weeks from now, 3 weeks from now, they will start to look like New York. And
Well,
you
I'm
know,
going to interrupt you there for a moment, James, because you talked the number 5,000. Well, we've got about that down in Australia. We seem to be containing it fairly well, and I want to talk the economic factors around this as well in a moment. But it seems to me that Australia has pretty much shut itself down. You don't think that that's going to contain it?
it'll help, but remember the what they call the period during which you don't show any symptoms, the asymptomatic period. They're guessing, but can kind of be as long as 2 weeks. So you have to go back 2 weeks. How many people had the virus 2 weeks ago, showed no symptoms, spread it around, and now, okay, you're shutting down the economy, you're closing pubs and restaurants and theaters and concerts and all the rest, which is good. It's good practice. No one disputes that. But that leaves an awful lot of cases yet to emerge. And then query how, the rules are set out, but how stringently people are following them. And so that I'll leave it at that. I don't want to belabor
Yeah.
it, but my point is, I remember when there were, a few hundred cases in New York, and everyone said, "Well, great, we're doing a great job. We've dodged a bullet." Meanwhile, the mayor had not shut down the public school system. Officials were encouraging people to go to the Lunar New Year celebration in Chinatown. They were encouraging people to go to the St. Patrick's Day parade in New York. This was long after this disease had spread widely, and then it exploded from there. So my only point is that whether it's Nigeria or South Africa or India, Chile has got an outbreak. Australia is at a certain level. I think we need to reserve judgment and maybe check back in 2 weeks and see where those are. Hopefully, you're exactly right that it has been contained, but that's not the history we see in a lot of other places. That's one thing. The other thing, I'll just be brief because I know you want to get onto the economy, is there's some optimism that with the warm, humid weather, the virus kind of dies out on its own, and that is true for a lot of types of flu. But we've never seen this before, so we don't actually know that. We're hopeful about that, but of course, you're going into your winter season right now. We're coming into summer. Maybe we'll see some relief, but maybe not. We're not sure of that. And more importantly, the decline. People here, at least U.S. public health officials, talk about flattening the curve. You have a very steep curve. Can we take the steps we've discussed and flatten the curve, which, by the way, does not reduce the total number of cases or fatalities. What it does do is it reduces the cases and fatalities at one time. It flattens the apex, but it could stretch it out over a longer period. So you get just as many cases, but they're not all walking into the intensive care unit at once. And that is helpful if you have a shortage of beds and equipment and so forth. But what we don't know is when it flattens and goes down, does it go down and stay down, or does it come back? In other words, is it a kind of a humpback curve, or is it more of a sine wave where it goes down and comes up and goes down and comes up? And we'll find out quickly because China has now opened up again. Wuhan is open. If you live in Wuhan, you can go to Beijing. That has not been true for 3 months, but they're now worried about what they call a second wave, and if they have it, no reason to think that the United States and other places won't have it as well. And there's no vaccine. I mean, all these analogies to flu. Well, we have flu. 20,000 people a year die of flu. Yes, they do, but we anticipate it, we expect it. We have vaccines, and there are things we can do about it. Here, there's still no vaccine, and there won't be probably for a year. So, in every dimension, this is far worse. Far from over, but let's hope the worst is behind us. Everyone wishes for that. There's some reason to reserve judgment on that. That said, the impact on the economy is undeniable. And here, what I suggest to people is you have to take out your 2008 model, your global financial crisis. Now, Australia was relatively unscathed. Australia held up well, as did Canada, compared to the rest of the world. And the places that got slammed were the United States, Europe. Those were the two worst, a little bit in Japan. China had a massive stimulus program, and Australia and Canada were just better managed economies and banking systems going into it, and they weren't hit as bad. But the effects were felt worldwide. Throw that out. 1998, Russia default, throw it out. 2000 .com, 1994 tequila crisis. All these financial crises or even economic recessions, the kind we saw in 1982 and in 2008, none of them are the right frame of reference. You can't use any of them as a baseline. You have to go back to 1929. That's
Wow.
the most comparable to where we are today. There's almost no one alive with a living memory of what happened in 1929. You'd have to be 95 or close to 100 years old today to have lived through that as even a teenager and remember what happened. So if we know anything about it, it's from books and study and graphs, and there's a lot of information. I'm not saying it's a dark hole. There's a lot you can know about it, but you have to have studied it. And you have to sort of take it in. But that's where you have to go now. But
No,
even then,
James, why do you make that reference to 1929? Why do people have to go back all that way? What are the similarities? Why are you mentioning that particular time frame?
well, it's the closest one in, if not living memory, at least the past 100 years. I mean, I think the right comparison might even be the 14th century, the Black Death, or maybe the 17th century plague in London. But just to use 1929. Now, what happened? The stock market fell. Using the Dow Jones Industrial Index, the stock market fell 89.2% from peak to trough. Right now, we're down about 27% on U.S. indices anyway. 89% is what a real bear market looks like. That's what a real depression looks like, not down 27%. So people jumping back into the market, the bottom is in, happy days are here again. Let's hope so, but I'm highly skeptical of that. I think it has a lot further to fall. Now one big difference. You said, why is that the right comparison? Stock market down 90%. Unemployment was 25%. In the Great Depression, we can expect 25% unemployment in the United States in the coming months. Industrial production declined GDP declined about 20% in the Great Depression. We can expect a decline of at least 30%, perhaps 40% in U.S. GDP. So the numbers will be worse than the Great Depression, but at least that's the right order of magnitude. But here's a big difference. Everything I just described about the Great Depression, stocks down, GDP down, unemployment up, deflation, by the way, we'll come back to that because that's relevant to gold, happened over the course of about 4 years, from 1929 to 1933. What we just saw happened over 4 weeks. So even if the declines and the shock is comparable order of magnitude, which it is, the time compression is unlike anything we've ever seen. You can't, wars are pretty horrendous, but you can't even compare it to a war. So things that played out over multi-year spans have played out in a couple of weeks. What that means is that, you can read the headlines, you can do the estimates, you can listen to the analysts and listen, to what I'm saying now. Say, I got it. It's going to be pretty bad. But people have not internalized this. People don't. They may know it at some abstract level, but their lives, their lifestyles have not been radically changed as of this minute, but they will be. 10 million Americans have lost their jobs in the last 3 weeks. 10 million.
10 million.
10 million, right. So that by itself would take the unemployment rate well past 10%, which is the peak of where it was in 2008. Or in 1982, we had a bad recession. It also peaked around 10%. It's going to 25%. Businesses are hanging on. And bear in mind that our economy was weak before the coronavirus. All this, happy talk from the White House about, the greatest economy in U.S. history. It's all nonsense. I mean, the economy was growing. The U.S. was outperforming other developed economies. We were doing better than our trading partners. But growth was 11-year growth from 2009 to 2020 was about 2.2%. And the annual figures clustered around that. We had no 3% years. We had no recession years after June 2009. It was very much around 2.2%. It was the same under Trump as Obama. The economy looked about the same. Trump didn't mess it up, but he didn't, double the growth rate of Obama. Those economies looked about the same, which tells you that there were forces at play that had nothing to do with the public policy or personality of the president. It had to do with demographics, debt, technology, other forces, if you will, high debt to GDP ratios that were actually more powerful than a specific public policy. So we were weak going into this. The Fed, until the end of 2018, had been raising rates. The Fed, over the course of 2018, had been burning money. Everyone, they used to run into people, they'd say, oh, I'm sick of the Fed printing money. I say, sorry, they stopped printing money in 2014. They were burning money. They were reducing the money supply from 4.5 trillion to about 3.8 trillion on their balance sheet between late 2017 and mid 2019. So the Fed was in a double tightening mode, raising rates and reducing the money supply. Now, of course, that's all out the window. Rates are back to zero. Where the balance sheet today, the Fed's balance sheet today, is $5 trillion. That's higher than it was at the peak of QE3, which was around $4.5 trillion. So the balance sheet's bigger. There's more money in circulation, and interest rates are lower, than they were a couple of years ago. The Fed was trying to get back to normal, and I said all along that in their effort to get back to normal, meaning 4% interest rates and the balance sheet of about $2 trillion, they would cause the recession they were preparing to cure. In other words, why were they trying to normalize the balance sheet and interest rates? Well, they wanted to get ready for the next recession. They didn't see this coming. I mean, practically no one did, but they knew it would come eventually, and they were preparing for it. But I said they would fail. They would not achieve their goals before they encountered a crisis of some kind, which would force them to retreat. And that is exactly what happened beginning at the end of 2018. Powell first said, okay, I'm done raising rates. And everyone said, well, that's good. And then he said, well, now I'm actually going to cut rates. And I said, well, that's good. And then they said, we're going to abandon our quantitative tightening. And we weren't going to print money, but we were going to stop reducing the money supply. People said, that's good. By the way, that's what drove the stock market up in 2019. Yeah. The Fed kept giving the market candy until along comes coronavirus. So we had weak growth. The stock market was overvalued. We were uniquely unprepared for what has happened. So the idea that a strong economy took a beating is false. A weak economy took a beating, worse than the Great Depression, and now we have to go forward from here. So so the idea that the stock market is somewhere near a low, negative interest rates are on the horizon. This depression, I don't call it a recession. It's not a recession. It's a depression, which is far worse. Let's see how long it lasts and what the damage is. But that's what we're in. And that has people you can say it, you can read it, but people haven't lived it.
Okay, so you paint a very dark picture, and we all know that the views of fiat currency are pretty dire as well, all this printing of money, etc. But in these dark times, how do people protect themselves, and how do they keep going? I mean, there's a lot of doom and gloom around at the moment. There's a lot of challenges with mental health. What is your prediction? Secondly, how do people protect themselves at this time, and how long do you think this is going to carry on for?
It's going to carry on for a few years, and there are a few things to look out for along the way. But this is not. See what you hear now when you watch financial television, or Secretary Mnuchin or Larry Kudlow is the president's economic advisor, et cetera. Who, nice guy, but has the worst forecasting record of any individual institution other than the Federal Reserve and the IMF. They're actually worse, but Kudlow's in that group. The expression you hear right now is pent up demand. Well, okay, we're all staying home. No one's going out to a restaurant or whatever. But once the doors are open and the virus is contained, we're all going to be running out, and that pent up demand. So no, this is a timing difference. Second quarter will be worse. Third quarter, maybe fourth quarter will come roaring back, and you'll get your V-shaped recession. That's nonsense. It reminds me of 2009, 2010. I remember, you were around, I was around. We heard the expression, at least in the U.S., green shoots. Everyone was, commenting, here come the green shoots. Look at the green shoots. That was nonsense. They were brown weeds. They weren't green shoots. In other words, we got 2.2% growth for 10 years or 11 years, but the average recovery since 1980 is 3.2%. We got 2.2%. So, and if you think 1 percentage point doesn't sound like a lot, it is. Take 1 percentage point times a $20 trillion economy compounded over 10 years yields $4 trillion in lost wealth. That's how much wealth we left on the table by not being able to get back to the old trend. We did grow, but it was depressed growth, and which is one definition of a depression. Now, the problem now is that where's this so-called pent-up demand? So my wife and I usually go out for dinner on a Friday night, which we do. We did not go out last Friday. We're not going out this Friday. May not go out for a while, but let's just say that by August, things are back to normal and we decide to go out for dinner. We're not going to order 10 dinners. We're going to order one. We're going to sit down and have dinner. Those other 9 dinners that we skip, that is lost output, permanently lost output. That's not a timing difference. Now, it's true that if I were going to buy a car last week and I chose not to because the dealer is closed, and I go out in August and buy the car, okay, that's a timing difference. We subtract it from second quarter GDP, add it to third quarter GDP. So that could be pent up demand, so-called. So that is a timing difference. So then what you have to do to analyze future growth is say, okay, well, of everything that's going on, how much are permanent losses and how much are temporary loss, timing differences? Well, 70% of the U.S. economy is consumption, and about 60% of that are services, not goods, meaning 42% of the entire economy is consumption of services, bars, restaurants, theaters, concerts, shows, movies, etc. And most of that, as I described, is lost permanently. So you're never going to get that back. And then the question is, how do you grow from there? Well, here, let's say you're a restaurant and you have 20 employees. Now your doors are shut. You've terminated all 20 of your employees. They're applying for unemployment, so they're getting some check from the government, but you've closed your business. You're hanging on because most of these kinds of small businesses are not well capitalized anyway. They don't have a lot of working capital. By the way, 42% of the jobs in the U.S. are small businesses. It's not, IBM and General Electric. It's restaurants, dry cleaners, pizza parlors, and the like. Okay, so now let's say it's all clear. The virus is contained. You reopen your restaurant. Are you going to hire back all 20? Or will you perhaps say, well, I'll hire back 10 and we'll see about the other 10? You're going to have the same crowd? No, because behavior changes. You're going to have to set up fewer tables because they're going to have to be further apart. In other words, you're not going to recover all that lost growth, and 10 of those people are not going to get their jobs back. This is for the ones who hang on. There will be a lot of bankruptcies in the meantime. People just say, sorry, I'm just closing up shop permanently. I'm not reopening this restaurant. And so when you take into account the permanently lost output, because it's gone, it doesn't come back. You don't have the 10 dinners as I described, plus the permanently lost jobs where you get terminated for reasons we all understand right now, but you don't get hired back for a lot of other reasons. This is depression-like characteristics. So will we grow again? Yes. Will we hit bottom? Yes. But we're going to hit bottom maybe 30%. I mean, I always talk about this all the time in terms of hedge fund performance. When you're down 30%, and then you go up 50%. Well, that's 50% of 70, which is only 35. I mean, that the math doesn't work in reverse in terms of. Let's say we went down 30%, which seems likely. Let's say we had 10% growth. I've never seen 10% growth in a quarter in the United States. I've looked at a lot of time series. The biggest quarter I saw was during the Eisenhower administration in the 1950s. We had one quarter where the economy grew 8%. We had a couple of years under Ronald, the economy grew 5-6%. That's what a strong economy looks like, 5-6%.
Yeah.
Well, let's say we go down 30%, and it could be worse, but let's say 30. So now we're at 70. Okay, 70% of the former GDP, and we grow 10%, which is off the charts. Well, that's 7. Now you're at 77. Guess what? You're still 23 percentage points below the prior level of GDP. You grow 10% again. Well, add 7.7 more. Now you're up to 84. And you're still 16% below the prior GDP. This could go on, will go on for quarter after quarter. That's if you get the kind of growth I just mentioned, which is unlikely for the reasons I talked about earlier. So it doesn't mean we don't hit bottom. It doesn't mean we never grow. What it means is that we don't get back to those levels for years.
Okay, so given that we're that dire prediction, as you said, this is not something that's going to go away, and people are talking up the fact that it will go away. What should people do?
Reduce your exposure to equities. I'm not saying go to zero, but stock markets have not hit bottom. Number one, build up a store of cash. People turn up their nose at cash. You go, well, it has no yield. Well, it doesn't go down 30% either, or 50%. But first of all, cash does increase in value in deflation. When you have deflation, I'm not talking about disinflation, I'm talking about deflation, which is coming. The value of cash actually goes up. Your dollar buys more if prices go down. So your cash is actually more valuable.
But James, sorry to interrupt you. Do you think that, if they decide to go to cash, is there a risk that the banks will, it's happened in Cyprus back in 2013. Is there a risk of having putting all your chips in the cash basket?
Well, I wouldn't put all in anything. I am saying build up a supply of cash, but yes, absolutely. Choose your bank wisely, and your instrument wisely. The banks in Cyprus were closed in 2013. The banks in Greece were closed in 2015. The banks in Lebanon are closed today. In 1933, the president of the United States closed every bank in the United States by executive order. Just signed an order, and every bank in the United States was closed. And he did not say when they would reopen. They did, in fact, reopen 8 days later, but they were closed for 8 days. So it does happen. It has happened, and it could happen again. ATMs could be programmed not to dispense more than, say, $200 a day for gas and groceries, but no more than that. I look out in the Hamptons. It's a very wealthy beach area outside of New York. A lot of billionaires live out there. People were queuing up to get. They walk up to the counter and say, "Please give me $100,000," and the person says, the teller says, "No, you can make an appointment. Come back next week. We don't keep that much cash on hand. We're not going to give it all to you and disadvantage other customers, etc." They're not saying you can't get it. They're saying, "Come back a week from. We'll give us a slip. We'll order it. Come back a week from now and pick it up." And I like to tell people, when you put your money in the bank, it's not your money anymore. It's the bank's money.
Right.
They'll give it to you if they feel like it. So there is some risk of that, but the way you get around that is, by having other assets and diversification and picking the most solid banks and dividing your deposits so you're within the deposit insurance limit. I think it's 100,000 euros in Europe. It's $250,000 in the US. Don't put more than that in. Just go find another bank. But
it's 250,000 down here in Australia as well for those listeners that are listening down here. It's 250,000 is our bank guarantee down here.
So if you have $1 million, you'll need 4 banks. And then the last thing is get some physical gold bullion. Now here, thank you for mentioning my book, The New Case for Gold. That book came out in 2016, and the other one came out last year. Thank you. So I recommend a gold at $1,100 an ounce, $1,200 an ounce, $1,300 an ounce, $1,400 an ounce, $1,500 an ounce. People mostly yawned, did nothing, and then occasionally I'd run into someone. I do a lot of public speaking, and they'd come up and say, "Jim, listen, I've heard what you say. I agree with you completely. Please call me like 3:00 the day before, and I'll sell my stocks and buy some gold." And I tell them a couple of things. Number one, I'm not going to know the day before. I'll tell you what's going to happen, the order of magnitude, what you should do now, but I won't know the day before. And if I did, I'd probably be a little busy myself. But what are you waiting for? I would look at them and say, "What are you waiting for? If you think this is coming, buy it now, because when you want it, you will not be able to get it." And that's what I'm seeing all over the world. The European refiners, some of them are closed. One of them just recently reopened, but they're operating at 1/3 capacity. They cannot ship the bullion to the United States because of transportation restrictions. The Brinks warehouse near JFK Airport, one of the largest in the world, is on half duty or half hours because they're trying to minimize the staff and the spread of coronavirus. The U.S. Mint is still producing coins, but they're back ordered for a year. They will not take a new order.
What? Can you say that again? I'll put the book down now.
Yeah, the U.S.
Mint is still producing, but you can't get them for how long?
A year. Because they're back ordered. There's everything that they can produce for a year is already spoken for, so they won't even take the new orders. Dealers are running low. You might find a small dealer somewhere with a little inventory, but good luck. So now that it's at 1,600, well, actually closer to 1,700 as we speak in the U.S., everybody wants gold. And exactly as I warned people, you can't get it.
So why is the price still You know, because back in, I think it was 2011, that the gold price was 1900 US. And interestingly enough, down in Australia, it was almost the same because we were parity to the US dollar, now the Australian dollar. And this goes back to your book, Currency Wars. Now
Right.
the Australian dollar is about 60 cents and the gold price. And ladies and gentlemen, this is very interesting because when you see the gold price mentioned on breakfast television, which I, by the way, never watch, when you see it, they never actually mention the fact that it's a US dollar price.
Right.
So our price right now is the highest it's ever been. It's 2,600 Australian dollars, whereas back in 2011, when the gold price was actually higher in US dollars, it wasn't as high. So I'd love your comment on that.
Sure. First of all, gold doesn't change. It's an element, atomic number 79.
Yeah.
If I have a 1 ounce gold coin and I put it in a drawer and I go away for a year and I open the drawer, I still have a 1 ounce gold coin. It didn't double, it didn't reproduce, it just doesn't pay dividends, etc. So the gold itself never changes. And I think of gold by weight, not really by the dollar price. So when you have a higher dollar price for gold, what it really means is that the dollar is getting weaker. People are losing confidence in the dollar. When you have a lower dollar price for gold, what it means is that confidence in the dollar is growing, or capital flows are coming into dollars. So the change in the dollar price of gold says more about the dollar than it does about gold. But I grant that it's how most people think about it. So look, like any other commodity or form of money or asset class, it has its bull and bear markets. We've had two great bull markets in gold. The first was 1971 to 1980, 9 years, gold went up 2,600%. The second bull market was 1999 to 2011, 12 years, gold went up 670%. But in between, we had a couple bear markets, 1980 to 1999, gold declined from $800 to $250. And in 2011 to 2015, another bear market where gold declined from US $1,900 to $1,050. Now look at a chart. You can pinpoint the bottom of that bear market, December 16th, 2015. Bingo. That was the bottom of the bear market. It is up 70% from there. We're in a bull market, but it didn't start last month or 6 months ago. It started 4.5 years ago. So if you simply take the average of the last two bull markets, because they're the only markets we have, and prior to that we were on a gold standard, or gold was just
That's
money.
right.
So you didn't have this free-floating dollar gold exchange rate. Just take the average. Don't go outside the boundaries. Don't extrapolate. So 9 years for one, 12 years from the other. So that's an average bull market of 10.5 years. One was 2,600%. One was 670%. So that's an average gain of approximately 1,300%. So come forward from December 2015, go up 13 times over 10 years, and you get to about $14,000 an ounce. And that's where gold is going. That's if we just average the last two bull markets. And by the way, I had an interesting conversation with our mutual friend, Jim Rickards, one of the great commodity traders of all time. And this was about 4 years ago or so, maybe a little bit longer. And he said, Jim, nothing goes to the moon without a 50% correction along the way.
Right.
So if you take $250 an ounce from 1999 as a baseline, because that was the bottom of the prior bear market, $1,900 as the top of the bull market in August 2011. So that is that's a $1,650 increase. Divide that by half, that would be a 50% correction, $825. Subtract it from 1,900, bingo, 1050 or 1075 is close enough.
1075.
In other words, when we hit 1050, that was a full 50% retracement from the peak. Exactly what Jim Rickards told me would happen. He said, when that happens, it goes to the moon from there. So we have our 50% correction behind us, and we're up 70% from that bottom. And that's just the beginning. My expectation, as I say, is it'll go up by a factor of 10.
So to my listeners out there, look, we're not telling you to sell your house and your children and go all in gold. But what you've just heard from Jim Rickards is if you want to protect your wealth, and some people say to me, Jim, I don't have enough money. Well, with technology these days, there are ways for you to put, $50, $100. You don't need to go, have $500,000 and put it in gold. What would you say to those people out there that constantly use the refrain of, well, gold has no value. I mean, very recently, I twisted a friend of mine's arm and had her change her US dollars into gold. And what she got back was quite a small little thing. And she keeps looking at it going, it's not very much. And I said, well, since I bought that tiny little piece of gold for you, the dollar value has decreased. So you've actually protected your wealth. And this is somebody that doesn't understand gold, but she did admit to the fact that, yes, okay, it's...
Well, I was once taking a taxi from the Las Vegas airport to a hotel, to the Wynn Hotel, and the taxi driver was very nice. And she said, "Like, what do you do?" I said, "I'm a writer. What do you write about?" "Well, a lot of things, but I write about gold and all this." And of course, this was in the depths of the. This was not long after the 2008 crash, and I said, I recommend 10% allocation. So she goes, "Well, I've only got $10,000 to my name. It's all I have." I said, "Well, fine. Buy 1 ounce of gold." It would have been, whatever, 1,200 at the time. So buy 1 ounce of gold, put it in a safe place, sit tight, and then, and then don't go all in. I recommend 10%. And you're right, 10% of your investable assets, not your net worth. Put your house and your business to one side. You don't want to gamble with those. But whatever's left of your investable assets, 10% of that in gold, you'll be very well served. Particularly now, when I said it at the time, gold was still very volatile, but I guess it's always volatile to some extent. But the trend is very clear. The bottom of the last bear market is well behind us. The growth in the new current bull market, 5 years old, is clear, and it will likely be the best performing asset class in the years ahead.
Okay, well, we've got to wrap it up in a moment, Jim, but I do want to ask your opinion on 2 things. The first one is silver. Silver's taken a bit of a beating recently. Just briefly, your thoughts on silver?
Yeah, silver will tag along with gold. There's no way that gold's going to 10,000 without silver going to, $100 an ounce or so. But silver is more difficult to analyze because gold actually isn't good for anything except money. I mean, gold is the best form of money, but it's not good for much else. Silver has a lot of industrial applications that gold does not have. So when you analyze silver, you've got a precious metal component, but you also have an industrial input component. And in a world where we're in a depression, the demand for silver will go down in terms of catalytic engines and electronics, but there's no way gold's going where I expect, and silver will not be along for the ride. So yes, get some silver.
Okay, great. Here in Australia right now, we're very much going cashless because everybody is terrified of, touching the coronavirus by touching cash. So we're going digital. Any thoughts on digital currencies, the Bitcoins of this world, or you?
Yeah, they said that the largest encrypted digital currency in the world is the U.S. dollar because, we may have a few bucks in our pockets or your purse, but the overwhelming 99+% of all transactions are digital. That message traffic is encrypted. So you can think of the dollar as a very successful cryptocurrency. Other cryptocurrencies I have no time for. I don't, never own them. There is no use case other than terrorists, tax evaders, and pornographers. So I don't touch them. I don't recommend them. But to each his own.
James Rickards talking to us from somewhere over in the US. We really, really do appreciate your time. I know how busy you've been. Ladies and gentlemen, I've got to tell you what the takeout for me is, this is not going away quickly, that we are in this for the long haul. You need to protect yourself. Jim just said 10% of your wealth should be in what we call money. All the rest is currency, and currency is credit. So, listen to people like Jim Rickards, listen to what he's saying, and make sure you pay attention. James Rickards, thanks for joining us on the Alternative Investment Show. My name is Kerry Stevenson. We'll see you next time. Oh,